Good afternoon, ladies and gentlemen. Today is Wednesday, January 15th, 2014. My name is Michael Camo, and I'd like to thank you for joining our webinar with Peter Tchir. Peter is the founder of TF Market Advisors, and he's also the author of Minyanville's Fixed Income Report. He has an extensive background in fixed income with stints running credit trading operations at banks like UBS, RBS, and Bankers Trust. We're here to talk about interest rates, the Fed, the economy, as well as Peter's outlook for 2014. This presentation will be recorded, and we will send you a link to the replay as well as the presentation slides. We're not going to go through every little thing in the presentation, but you will be able to get them later, so don't worry about it. So, Peter, I'd like to thank you for joining us. How are you doing?
Very good. Thanks for having me.
Okay, so we're going to jump right into some recent news. In the past couple days, we've started to get earnings from the banks, and you've been somewhat cautious on housing, and we're seeing mortgage originations from JP Morgan, Wells Fargo, Bank of America are down substantially. MBS production is also down. So what does this mean near term?
You know, I think near term we are seeing signs that the housing bubble, or sorry, the housing recovery is getting overplayed. I think even if you saw in the Beige Book today, a couple places mentioned that prices are stabilizing or even going down. And I think this is going to be, this is part of the problem of what the Fed has done. They pushed mortgage rates so low that it was impossible to make good amounts of money, so the big banks have been cutting back on this. So the only people who are getting mortgages are those who qualify for, programs, or I think, larger institutions that have been able to buy blocks or tracts of housing. So we haven't had this true mortgage origination rebound like we had in the early 2000s. So I think it's overall a little bit nerve-wracking about where housing is headed, and it's also an early warning sign of how difficult it's going to be to get out of this QE quagmire, because the Fed has effectively stopped banks from being able to make money in the mortgage spot for the last year, so they're laying people off, they're not there. It's going to be hard to have a proper recovery if the real mortgage lenders are out of the business.
Okay, so speaking of the economy, we also had the NFP report on Friday was, I think it was the worst since maybe September 2011. And up until that point, people were seeming to root against the bond market quite a bit. And that kind of put a stop to that. Now, do you think that has any near-term impact on treasuries? Like, will we see a persistent bid because of these new concerns?
I think we are going to see, again, we were relatively bullish at the start of this year, treasuries. We pulled back a little bit. We're still bullish. 285 is our target, down from 3%. We think it can go maybe to 275, but we want to be able to add if we get a little bit weaker. I think one of the things that had happened, and even we're still seeing this, post-NFP, everyone has an excuse why this miss doesn't really count, but no matter what, it did happen. And I think people had actually gotten way too excited about the growth trajectory the U.S. was on. Our belief is the U.S. is growing, but only okay. It's going to go between periods where we question whether there's growth and some periods where it seems growth is better. But we are still at this low growth stage. Inflation is still relatively low. So I think treasuries actually offer some value here as a trading strategy. And so many people are short or underweight that I think there is that potential to get the squeeze where being short treasuries is painful. It's all exciting to talk about, oh, it's going to go to 3.5% or 4%. Well, if it goes from 3 to 285, you just lost, 3/4 of a point on the 10-year. Plus, you're stuck paying this carry away. You've got the borrowing cost. So I think people underestimate how difficult it is to be short treasuries or yield products. And I think we are going to get a squeeze as everyone got too comfortable with the growth story, and everyone got so comfortable that long equity, short fixed income was the way to trade.
Okay, so now, to be fair, that was just one report, and they've been, for the last few months, decent. Do you think,
but I think even
if the next one is good, do we kind of go back to where we were?
Maybe we get to 3%, but again, I think when we look at one of the things that's very key to us is we look at the shape of the curve. So we are paying very close attention to where the 2-year is versus the 10-year versus, and even where forward rates are. So one of the things right now that I think people are forgetting is if you invest in 1-year T-bills instead of putting your money in the 10-year, at the next year, you need the 10-year to be at 3.45% yield or 3.4% yield to have broken even. So I think people are underestimating how powerful that carry is, how steep the curve is, so this roll down has a big impact. We look at where inflation is, under one, around 1 some odd %. We look at where growth is. I think even if we get data continuing where we get back to 170,000 NFP type jobs, rates are probably 275 to 3 some odd %. I think people were expecting huge convexity buyers. So they were expecting the mortgage hedgers to come in at 3%. We hit 3%, crossed 3% multiple times, including, the day I believe it was of the minutes, and we did not burst through. So I think that hope that we are going to go to 325 or 350 quickly is over. I think the best case we get to 3% again, but I think more likely we grind tighter as people have to take off shorts.
Okay.
Even with some additional decent reports. I mean, today we traded.
I'm sorry, go on.
Today and even yesterday, right? Particularly today, though, the long bond was basically unchanged or down a tiny bit. We had every excuse again to sell off. So I think it's going to be this few days at least where you see strong support for treasuries and yield-based products. It was interesting, right? High yield was up today because, again, it moves with the shorter-term treasuries, but credit spreads did so well. So within the fixed income world, there are assets that are even a better way to play this than treasuries.
Okay. All right, let's talk about yields, because in the history of Minyanville webcasts, and this goes even before we partnered with Peter Tchir, the question is always about where are rates going. Now, you obviously look at rates all over the world, but everybody's obsessed with the 10-year Treasury. And I know you're pretty flexible, but where would you say that the 10-year is going over the next 3 months?
I think we're probably 275 to 310 unless we get some really, interesting economic data that's either very positive or very negative. And I think we are in this, muddle along type economy where it's not going to go negative, so that will keep yields up above, say, 275, but we're not going to see this huge signs of growth or inflation, and so that's going to keep us under that 3.1% sort of. So that's kind of our base case, and that's really what we see the most likely is that fairly narrow range for the 10-year, which lets you price every other yield product off of that.
Okay, now in terms of a more like an extreme move, say to because I think people are talking a lot in extremes, what would you say the probability is of a move to 2.5% on the 10-year or 3.5%? Because I think a lot of people are making kind of dramatic forecasts, and I think it would be helpful for you to provide some perspective on how likely those types of scenarios actually are.
I would bet much more likely on 2.5% right now, and I think there's probably, in the grand scheme of things, a 10 to 20% chance of getting there, and I think it's less than 5% that we get to 3.5%. And that is large part due to the fact that when we pushed through 3% a couple times and couldn't gap wider, that really tells me there is not that need for convexity hedging. The mortgage guys are not offside. There isn't that need to hedge. And when we talk to some of the larger pension funds, most are very comfortable now with their income side of the portfolio that they have brought their costs down so much that earning 4% on the long bond, that's plenty for them. They are making money and eating into their adding to their reserves at these yields. So institutional money is fine at these levels. We saw that there wasn't this need to push it higher when we went through 3%. So I think the next move is actually tighter, and I think that's when we see, TBT, we'll start seeing shares outstanding and that drop dramatically as everyone realizes they're on the wrong side of this trade. That the yields have already priced too much in.
Okay, and as far as the broader economy goes, what do you think is more likely, an acceleration in growth or some kind of, downward shock in growth?
I think downward shock. I think the housing story is not as good as people have been led to believe. I think the data has been so all over the place between, we had the government shutdown, this, that, and the other thing. We're not seeing consistent signs of real growth. We're seeing, retail spending was okay, but that was after a lot of downward revisions. I think we are going to see disappointment to the growth side rather than an acceleration of growth. And so I think we will see, if anything, economic disappointment, which I think will actually hurt stocks, because one of our beliefs is that we have moved away a little bit from trading the QE story or the taper story, and it's getting back a little bit more to economic data, and stocks in particular need growth up here to support these levels, and treasuries as well to stay at this, even 285. They need real growth. You start pulling that back, and again, I think that's where you see the snap to 250.
Okay. Now, as far as stocks go, do you think stocks are overestimating economic growth? Because we're seeing Q4 earnings stats are pretty awful. Estimated growth went from something like 9% on September 30th to around 6% now. Do you think there's kind of a little bit of frothiness there?
I think there's definitely frothiness. I think we've seen it already. These pullbacks, the past 2 days have obviously been back to strength. But the underlying sense that I get is more large investors are getting a little bit nervous. Everyone is a little bit long. It's when you're out there talking to people during the trading day, there seems to be more a sense of relief on up days and fear on down days than you would like, right? If you get the anger on the up days, it means everyone's too short. When you get everyone kind of happy and breathing a sigh of relief but not looking like they're adding, it tells you I think they're too long. So I think people came into this year relatively aggressively positioned. I think one client told me something I think is probably about right, is we borrowed 5% of equity upside and stuffed it into last year, and we're actually likely to give a bunch of that back because it was premature to take that last 4 or 5% move in December.
Okay, so we are going to get out into your outlook for fixed income in 2014, but why don't you talk a little bit about, I guess, how you generally construct portfolios, specifically your views on going for total return rather than viewing everything specifically in terms of yields?
Yeah, I think that's one of our biggest things is I think people get too caught up in, what's the yield on this? And, and really have to be looking at trading this nimbly, looking for the best opportunities that fit your view. We liked high yield at the start of this year. We've liked it for a while. We're actually starting to pull back on high yield. You're up almost 1% on the year on high yield. And to us, this is how we think of it, right, is you started at something that's yielding about 5.5%. Let's just keep the math simple. Say you could get a high yield mutual fund or ETF yielding 6%. That's 0.5% per month is all you're going to earn in interest. We've made 2 months worth of interest. We're a little bit worried about where spreads are. We're a little bit worried about where rates might go. So we will pull back from there because we see the opportunity. If you could buy it back lower, that lets you generate the returns, right? You want to trade this, and people get too carried away with, well, if I'm sitting in cash, I'm not earning interest. Well, you earn only a little bit of interest each day, and so you want to trade around that. So we are actually been pulling out of high yield a little bit over the past weeks, and we kept a pretty decent allocation. I think we're going to take that down to 0 because the performance has been too good. We don't like that the ETFs are trading at premiums. It makes us nervous when you start trading at record low yields, record low spreads, and at a premium. It tells us it's gotten too frothy. So, when we look, I think one of the most interesting slides that we put together, I think, is, and it kind of helps explain how we look at the world, is on slide 19. But, each product has a duration risk. So how much is it going to move based on rates? And so funds that invest in shorter dated bonds have less of that exposure. Funds that invest in longer dated bonds have more of that exposure. Will they move with treasury rates or will they move with credit spreads? And again, we liked high yield because generally you get this negative correlation, right? Even if rates are moving up a little bit, credit spreads are generally tightening because the economy is doing well. So that was one of the reasons we liked high yield so much. Right now we will probably shift more into leveraged loan funds. We like those. Some of the closed-end funds are at a discount. The ETF is out there. But we like that because you're still getting some decent amount of spread. You give up the upside, but you should be protected on the downside, both from a rate side and even from a spread move because these are senior secured loans. They're not going to have that risk. So I think whenever we look at it, we decide how much duration risk do we want to take, how much interest rate risk, how much credit risk, and then we find where the best place is. Another area that we were long coming into the start of the year and we've been paring back were municipal bonds. And we chose municipals over treasuries because we thought, if you look at MUB, the municipal bond funds tend to be fairly long dated. So you were getting a lot of duration from there. a lot of rate risk and a lot of credit spread risk. So we didn't need treasuries because we would rather take our yield exposure through MUG. And I think that's the thing that you wind up having to do is, how much rate risk are you comfortable with? How much credit risk are you comfortable? Where do you think people are mispositioned? And figuring out what risk to take. And then once you've found the best trades, you don't need to be in treasuries because there were better ways, cheaper ways, more effective ways, better positioned ways to take your rate risk. And I think that's one of the things people have to get more used to looking, especially as, we've moved to this overall, fairly tricky environment to trade, is really figuring out what risks you're comfortable with, what risks you want to take, and then what is the best way to express that view.
Okay, so you brought up ETFs. Now, what I'd like to know is, how do you decide which ETF to use? I mean, do you look at discounts and premiums, and when do you go with closed-end funds versus ETFs?
I think those are great questions. I think it's something everyone's kind of spending a lot more time looking at. I would say, for us, for example, leveraged loans are something that we are fairly comfortable with as being a core part of our strategy right now, because that's kind of a nice income, I don't want to sound too cavalier, almost a cash equivalent. Like, we believe the leveraged loan market is well positioned. So for that, we would probably look more towards mutual funds or closed-end funds that are trading at a discount, because we believe we'll be invested long enough that you will get that extra performance from finding a good manager, or you'll have enough time for that closed-end fund discount to, shrink, so that will be some additional P&L. There are times, again, if we pull out of high yield or even decide in one of our more aggressive strategies to go short high yield, I think there we'd look to do something in an ETF where we want that fast trading capacity. We want that ability to do some intraday trading. We want to make sure that we can just, looking for raw beta. But even within that, we're starting now to look, when we say we like high yield, well, we've got to be more careful and more specific of what we like. And if we like the higher coupon, less liquid, more esoteric pieces of paper, then we're going to have to move more towards a mutual fund, because the manager can get that, whereas the ETFs tend to be a little bit more of what we call the go-go bonds, the big liquid bonds. So we're having to start differentiating, when we say high yield, what part of high yield do we like and what fits that better. And I think that's really the analysis. And we're starting to come out, I think, on the high yield side in particular, even where we like to trade it, we're going to move probably more towards a mutual fund or closed-end strategy from time to time, because that's where we see the value part of the curve, not owning the 4.5%, community health bonds, which tend to be a high percentage of the ETFs based on the index that they have to match.
Okay, so
go ahead.
So would you say it's important for people to kind of stay class agnostic, because I think ETFs have become very trendy. They've had lots of inflows, and mutual funds are seeing outflows. But you use a mix of all of these instruments?
Yeah, I think, again, one of the things that we think, and even at the institutional level, has given us a good competitive advantage with our customer base, is that too many restrictions get placed on people in fixed income. People are treasury guys, or they're investment grade people, or they're high yield people, or they're bond people, or they're CDS people. And really, I think you have to be much more agnostic and look, what do I like? And then within that, where is the best value? What seems to be most shorted? What seems to be, offer the best return? Again, in the summer, we really liked high yield and munis, and we really liked the closed-end space. In particular, there was probably the first time in a year and a half that we've liked closed-end funds, and it was because they were trading at this 10% discount, and so we really thought you would get this nice self-fulfilling, if we were right about the asset class doing better, not only would it do better, you get the leverage return in the closed-end fund, but as the closed-end fund does well, it attracts capital and that discount goes away. So yeah, I think it's very key to be much more agnostic. Obviously, with some mutual funds with fees and stuff, you have to be a bit more careful if you really think you're going to be trading this for 2 weeks. Maybe even if you like a mutual fund better, you have to be in the ETF. But that to us is the process, right? What do we think about the rate environment? What do we think about the credit environment is our first layer. Second layer is, within that, what parts of credit or fixed income or income would we like better? Do we like munis? Do we like high yield, leverage loans? Then within that, how do we want to put on that risk? Should it be a mutual fund? Should it be a specific bond? Should it be an ETF? And that's kind of our process. And we think by doing that, that's where you can find that extra, edge and the outperformance.
Okay, so speaking of products, what do you think is going to be the next thing, at least on the exchange traded side in fixed income? I mean, what kind of things should people be looking for to come on the market that will, I guess, allow them access to new areas that they haven't been able to get to before?
I think one thing is there will be some credit derivative-backed products. I think, what may surprise some people, HYS, which is a PIMCO high-yield mutual fund, or ETF, it only invests in 5-year and in bonds in theory, but currently 10% of the portfolio is in CDS, and as recently as December it was 15%. So you're starting to see credit derivatives make more of an appearance in ETFs. I think that will continue because investors want to focus on spread-based products, and credit derivatives by their very nature is pure spread risk. And so I think as people start saying, hey, we need, this is a conversation we have with lots of people, I'm comfortable with investment-grade credit risk, I'm not comfortable with rate risk. Okay, well guess what? Selling credit derivatives gives you that exact exposure. So I think stuff like that will start making its way into the products. I think as retail investors as a whole become more sophisticated with their income portfolio, I think you might start seeing better curve trade type things. So you might see 2s, 10s ETFs that lets people express those views. I do think we will see more and more ETFs that are focused on foreign assets. So IHYG is out there, which I think is now $3 billion, which is European high yield. I think you will see more of those products that give you, so I see two things. One we call, in quotes, market access type products. So retail or RIAs will be brought products that they couldn't access before. So BKLN really brought leveraged loans in a new way to that space. I think that's where you'll see CDS, that's where you'll see European or foreign bonds making a bigger impact. And then the other is going to be, hedge fund light type products, so spread trades, curve trades, things like that, that retail hadn't really focused on. But I think you're seeing more and more, starting with the family office and the high net worth individuals, there is that demand for these products that really had only been hedge fund type products until now. So that's kind of the two ways we see the ETF market developing over the next year.
Okay, so as far as the 2014 outlook goes, you talked a little bit about some of the sectors you like, but just so people know, what would you say is the most underrated area in fixed income and most overrated right now?
We still like leverage loans. I think people are still underallocated to that. We like the senior secured nature. We like the floating rate. One of my first clients, this goes back far too long to talk about, but they said, and I believe it to this day, leverage loans are probably the most misrated asset class there is. They get 1 or 2 notches upgrade because they have security. Reality is the performance in good times and bad has been very, very high for leverage loans. If you pick the right ones, you get high recovery rates. So I think that is a nice cash component of your portfolio and creates some nice income. I think the focus on the 10-year Treasury, the long bond, that's kind of out there, and maybe even TLT or TBT have made so easy to trade. People have to get away from that and step back and do a little bit more work and look a little bit harder. So I think kind of the most overvalued, overtraded are those Treasury type products. And then probably the most interesting one I still think is, in the municipal space, what to do with Puerto Rico. And what was encouraging is this week, the situation in Puerto Rico actually seemed a little bit more negative from a credit standpoint, yet bond prices were able to rally. So that's something we're watching closely. And we do have a belief that too many people sold too much Puerto Rican debt, that you want a little bit of that exposure in your portfolio at these prices, and given how oversold it seems.
Okay.
So that's a weird one.
Okay. So I think that's a good spot to wrap up the presentation and move on to the Q&A. So anyone out there has questions, feel free to enter them into the box. We have a lot of questions, so please get them in now. So speaking of munis, munis have done quite well lately. Do you think there's still opportunity there?
We do. We've, when we looked at our allocations, we had a very high allocation at the start of the year to munis. They've done so well, we're pulling back, but we are keeping some. Our big concern and what we are trying to get a sense of is what to do with Puerto Rico. The positives we view that is, I think PIMCO actually tweeted it out that, they were out of Puerto Rico. So to us, that's very positive. When you get all these big mutual funds claiming they're out of something, it means they're underweight if you get any turnaround. It's the exact same story we saw in Spain and Italy over the past year and a half. So that to us is encouraging. What makes us still a little bit nervous is I know, S&P or Standard & Poor's for some of their indices may have to remove Puerto Rico, and there still may be more of this forced selling phenomena. In the corporate bond world, most insurance companies don't have to force sell their investment-grade bonds when they get downgraded. To us, it's a little bit less clear that that won't happen in munis, so we are being a bit cautious in case you get another pullback related to Puerto Rico. But as a whole, yeah, we think there's more upside. We think it looks like the cheapest spread product, and we are getting, people who do not get the tax advantage of munis are starting to look at them as a quick total return product because they do look so cheap relative to anything else. So, okay. Yes, we like them. We pulled back a little bit, but we will be looking to add.
Okay. Do you think interest rate risk has been mispriced because of the Fed?
No, I don't. I think the market is big, liquid, and trades every day. And if it wanted to be at 4.5%, it could be at 4.5% regardless of the Fed. The biggest thing, the Fed holding short-term rates, I think that misprices the front end of the curve much more than the back end, right? So the difference between the 2-year Treasury and the 10-year Treasury right now is around 250 basis points, which is extremely high historically. So I think even if the front end starts moving higher because the Fed starts talking about rates, we will not see as much pressure on the back end. So no one is, I think that is one of the big misconceptions is that the Fed is so mispriced Treasury market. I think the Treasury market has priced itself, and I think it's now gotten too cheap, and that's why it's coming back, because too many people who don't look at it have kind of jumped on this bandwagon that the Fed has, changed the price. So long as the Fed holds short-term rates low, inflation does not pick up, which again, there's been no signs of inflation truly picking up, and economic growth is only okay, we are at fine and acceptable levels for the 10-year. The funniest thing is we pulled up, and I believe, I've got to pull up the exact numbers, but I think the 10-year average yield on the 10-year right now is around 3.4%. So we all talk like, oh, we're way underweight. And yes, some of that's been affected by the last few years. But the 10-year Treasury is not super expensive anymore. And I think it trades as a real liquid market.
Okay. Another one tying to recent news. Are you following the, I guess, the alleged student loan bubble? And do you have any thoughts on student loan-backed bonds?
We've just very generically, I think it scares us, and it does seem like a bubble, and we are trying to figure out how to get up to speed on that. It's not been an area of expertise for us. So, we've looked at it superficially, but not enough to get in. But it is a growing concern. We're also, we started doing some work also on subprime auto loans, where those have started picking up to what seem to be very aggressive paces again. And, maybe they've got more room to run, but that's something else we've started watching is some of the subprime lending activity has ticked up, where people are relying, again, on the asset value of the car to make the loan rather than the people buying the car. And that tends to be where you get those problems eventually hit. So, yeah, we're seeing early signs of bubbles that make us nervous.
So let's talk about the Fed. Do you see anything different with Yellen versus having Bernanke?
It's definitely difficult to say, but I think there will be more room for input from other people. She seems to be more comfortable with that. I thought Fisher's speech yesterday with, his reference to beer goggles and other things was like, I know he tends to be a little bit more aggressive and outgoing, but even that seemed a little bit more aggressive and outgoing than he would normally have been. I like that he ended that that's how he plans to vote at the FOMC, so maybe we will get, everything under Bernanke seemed very controlled, very organized, and it always felt like there was a playlist and, okay, Bernanke would tell you go out and speak and you say something negative, you go out and speak, you say something positive, tomorrow you line up a speech and we'll see how it goes. And I think there'll be a little bit more free reign for people to give their opinion, because I think that's just the feeling that I'm getting and what I'm hearing a little bit in the background.
Okay, another Fed-related question is, do you think the Fed has fundamentally changed the function of markets like MBS?
Yeah, I think, and we've had conversations even with people at the Treasury Department. There is real concern that what you're seeing at J.P. Morgan and Wells Fargo on the mortgage origination side is very detrimental, is that you're chasing true private money out of the market. And how will you ever have a truly functioning market again when you've chased out real end users, the real originators, the real providers of credit? So, yeah, I think they've done a lot. I think they've hurt everyone by this lack of volatility. I think, even some of the hedge funds who kind of glommed on to the idea that, oh, this is great, Bernanke's in, all this stuff. I think people are like, whoa, this complete lack of volatility, this and total control is actually very nerve-wracking and bad for everyone. So,
okay, so let's assume we kind of have this muddle-along economy for, let's say, 2 years, and let's say the Fed tapers to zero. Do you think there's a permanent, I guess, psychological change in market participants even after the Fed leaves? I mean, do you think maybe people, because of the lack of volatility, do you think people might be too complacent going forward?
I think far too complacent, but particularly on the equity side. And again, it's funny. Equities have done much better over the year of QE than fixed income or credit, and yet everyone seems to want to talk about, has the Fed mispriced treasuries? I would argue much more, has the Fed mispriced equity risk for everyone? Has Fed mispriced equity or volatility for everyone? I think the answer there is more clearly yes. You don't get Dave Tepper going on CNBC shouting, slamming his fist saying, the Fed's printing money, so buy treasuries. You got him there saying, Fed's printing money, buy stock. So I think people are misplacing, to some degree, what asset class has been mispriced by QE. And I think if we get this middling growth and we start pulling away from the spigot, we will see equities pull back to a lower multiple. And we will see volatility start to increase, which again, what we like to do is we want to get short when volatility is low, and we want to get long when volatility is high. And right now, volatility is coming so low that it's making us very nervous that I would not want to be long in this low volatility environment. And again, everyone grows positions that are too big, and because it's all volatility adjusted. And as volatility spikes and markets are selling off, they are going to become forced sellers rather than buy the dippers. So again, we're not horribly bearish or anything, but I think we're much more prepared for a bear market, and we will watch that, and we could see an acceleration if we get any really weak data while the Fed continues to pull back.
Okay, so do you think volatility will increase this year? And if so, what could set it off?
I do think it will increase. From the simple end, maybe people start getting fed up with weak earnings. I mean, so far we've been resilient to earnings. Maybe that's the trigger. I do believe that Europe, is roughly due to start another problem. Everyone's become very complacent about Europe. Everyone's been playing very nice in the sandbox in Europe. Given that it's a political as much of an economic situation, it seems that someone's liable to do something where either Spain or Italy get too aggressive and have to get smacked down, or Merkel thinks she has to say something to garner some support in Germany. So I would say Europe is probably our likely hotbed. But again, everyone else is looking, China and Japan. That situation does not seem good, where both sides seem to be making a little bit more, saber rattling certainly. And we're not sure what's happening with Abenomics or Abenomics.
Okay, another question related to treasuries. Because money velocity is so low, do you think that's ultimately bullish for treasuries?
I don't know on that one, sorry.
Okay. Okay, so we have another question. So how do you feel about JNK versus HYG?
In general, I would say right now, I would prefer to have HYG than JNK. And partly, and this could just be my belief, but from some of the work we've done, I do think BlackRock spends more time trying to ensure that the portfolio they're getting is less subject to, outside influences. I think they do a better job trying to get some of the new issues into their portfolio. I think when I look at it, BlackRock as a whole has a huge infrastructure built around managing their ETFs, and I think they spend a lot of time and consider it a very serious fiduciary responsibility to manage those bond portfolios very clearly. And to me, the other side seems a little bit more like the sideline business, that they are, when they do create and redeems, they are less insistent on which bonds they get or give out as part of the create redeem, that they may do it for cash. So for that, particularly as we're getting frothy, I would prefer, I think, to be an HYG, because I think they will maintain a better control of a process.
Okay.
But the two portfolios are very similar away from that, and that's kind of why I'm biased that way.
Okay. How do you feel about emerging market bonds?
We've been liking them a little bit. We spent most of the last year being very scared of them. We like a small allocation of them because, again, our fundamental view is that Treasury yields are supportive here, but rather than buying Treasuries, I think we'd like to be in other classes that have some yield play. So we like EM. What we liked about EM is all the stories are awful. You can go across, and most of the stories are pretty awful, but everyone knows they're awful. And from a credit side, a lot of that awfulness is priced in. They've been underweight. We've seen outflows from the ETFs. We've seen people have difficulty putting on the ETF ARB in that place where they just couldn't even find a real buyer for the bond. But that we've been slowly seeing change, and we think, again, it's kind of that bottoming process where people are looking around and we start, you see HYG up 1% year to date, even with EMB up a little bit. I think it doesn't take much to get it. And what people forget, too, is, I don't know if people forget, but the EM markets tend to be relatively small floats. You've got the locals that tend to hold a fair bit of debt off in local currency, but they rarely sell, right? They're in the business of holding their own debt. So when you see foreign flows come in, you can pop it up quickly. So we like EM and probably considering adding to that. We also like, I think, preferred bank debt here, preferred stock of the U.S. banks. The big money center banks has been another area we've liked that had been out of favor and we think is slowly turning around and offers some good value. And is a much better way to, again, EM to us is a much better place to take your yield risk right now than Treasuries to us.
Okay, and one final question is, what is your favorite place in terms of European bonds, which I would guess means sovereigns like Italian or Spanish bonds?
We've been a bit frustrated because we've, probably about a week ago, we decided we liked EM better than Spain or Italy. Since then, they've performed about the same. We're just uncomfortable. We're kind of on the sidelines there. European corporates, European high yield offers 150 to 200 bips pickup compared to the U.S., so we like a little bit of that. The yields there are better for similar credit risk. We're a little bit nervous that we get hit by any hiccup, but I think if we go to Europe now, we're looking more at European high yield corporates as the place to be, as kind of the next wave in Europe fixing its problems is where we'll see those spreads come in a lot. And so again, IHYG is like one way to take a look at that.
Okay, and that will wrap us up. Folks, as a reminder, we will send you a replay. We will also send you the full presentation slides. There are actually 23 slides, so there's a lot more information about Peter's general investing philosophy and risks you should be aware of. So, Peter, thank you very much for joining us, and have a great night.
Great. Thanks very much.
Thank you, everyone.